Welcome, everybody, back to the Growing Money with Sean Trace podcast. I've got an interesting guest with me today. Would you like to tell people who you are and a little bit about what you do?
Yeah, my name's Tim Craven. I live in Nashville, Tennessee. I'm here to talk about growing money in real estate today. I'm a licensed real estate agent. I'm also a musician. So here I am in my studio talking about real estate.
That's awesome. I love your studio, man. It looks like really comfy.
It is comfy. I try to keep things low key in a very keyed up world. I try to stay as low key as possible.
Well, you've come on before and talked about your journey with buying and how you had started. You bought really early in life. But I want to ask you a really basic question about real estate. Like, why is it important to buy something? Why should someone buy?
Well, the quick, easy answer is that if you're renting, you're paying somebody else's mortgage and you're building equity in somebody else's property by renting. Whereas if you purchase a property, the money that you pay each month in your mortgage goes to build equity in the house that you currently own. So, a lot of people kind of misconstrue the idea that the bank owns the house and, I'm paying the bank. And it's like, okay, yeah, I mean, technically you are paying somebody. They loan you the money. They hold the deed to the house until it's paid off. And then they transfer that deed or that, note to you, the ownership. But what you're doing is you're paying down the debt and increasing the value of the house. So the closer you get to zero, the more you own of that house. And then when it's free and clear, you own it outright. And then what you can do with that is sell it and make money or grow your money to kind of go in with what we're talking about. Whereas when you rent, you're just writing a check to somebody else. You'll never see the return on that check that you're writing.
There was one thing that I watched this class from, I signed up for, I've been really binging these courses on Coursera. And I have this monthly fee that I pay, and I get to take all these courses and get these fun certificates. And I don't know if they matter or will help with my career or life, but I like the certificates. It reminds me of being a Boy Scout where I get the little badges on.
Yeah, the badges.
Okay. It's exactly what I feel like. It's a big kid version of that. But one of the things is I've been taking this course on personal finance. And when they discussed buying houses versus renting, and they said, there's a time and place for everything. But one of the things that the guy said that was really interesting to me is he's like, when you buy, it's like forcing you to put money into savings because you are required to pay down your mortgage, but if that person's like, well, if I have all that money and I'm setting it aside and I'm doing it in something else, but are you? Are you?
Right.
Like so many people say, oh yeah, I could put that straight into savings or invest it. Would you? Like for many people, yes, they would. But there's a lot of people, quite a few people that are going to be like, woohoo, and just toss it aside.
There are a lot of people out there who disagree with what I just said. There are a lot of people out there that disagree with the idea that a mortgage is the way to go or buying a house is the way to go. They think that renting is the smarter way to go because a mortgage really benefits the lender. Because if you look at the mortgage, which is, in the United States, typically is 30 years, you end up paying back with interest more than what you actually paid for the house. So you might pay $400 for the house and then end up paying back $650 at the end of the 30-year term. The thing that you need to do is understand that there are many options between day one and the last day of the 30th year that are available to you to cash out and make money or cash out portions of the equity that you've earned in that and then take that money and apply it to other ways, other purchases or other investments or other ways to make money. So I understand the viewpoint that, people are like, oh, mortgages are the worst thing you could do because you're benefiting the bank and blah, 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 blah. But there really aren't a lot of other choices. I mean, not a lot of people are walking around with $500,000 in cash that they can buy a house in cash. Obviously, if that's what you can do, that's really the way to do it. But that's not available for most people. So most people, the way that they can grow their money is to understand their market. So let's say that you have a mortgage on a house and your interest rate that you're paying is, current rates, 7.5% in the United States right now, let's say, a conventional 30-year mortgage. You need to look at your market and see how much your property is appreciating. So in Nashville, not recently, the market's taken a huge downturn because interest rates have gone up in the United States, which has pushed the market down. Prices are coming down. People aren't selling their homes because they're choosing not to because they can't get the price that they want. Buyers have slowed down because they can't get the financing that they want, affordability that they want on the financing because interest rates are higher. All sorts of factors. So things have slowed down considerably, but at the height of what was going on in the United States 2 years ago, you're looking at, like in a city like Nashville, you were looking at anywhere, depending upon where you were living. But like, let's just talk about the urban core. You're looking at like anywhere from like 8 to 12% return year over year on your investment. And you're paying 5% in interest. So there's a 6 or 8% gap in there that is benefiting you, in the sense that what you're paying to have ownership, or what you're paying to have that house, is less than what it's actually appreciating for. So your available funds, if you will, or your equity is growing faster than the rate of which you're paying in. And when rates were 3.5%, it was even more so. It even made more sense. So, those are the things that I think a lot of people who are contrary to the idea of owning real estate, they think that you're getting sucked into something that you're going to end up paying more than what you started with. But as far as investing in the United States, like, I'm not an expert at investing, but I have money in the stock market. I have, some diversity in the stock market. I have money in life insurance, whole life insurance policies that I got back when I was 20 that have cash value that I can take from time to time if I need to. And then I've got, equity in my home, and I'm working toward purchasing another property for rental income, probably like an Airbnb kind of thing. So, the numbers don't lie. People who get into real estate and know how to work it properly, they make money, and they grow their money, and they can grow it quickly, and they're going to grow. It's going to grow if you do it right, and you know what you're doing, and you take the time to really think about what you're doing and try to find a good deal, and then also try to put down more money so you have more built-in equity day one. You can grow your money pretty quick. It grows fast. So, like, for instance, like, a home in Nashville in 2015, similar to mine, would have cost you about $400,000. You can sell that now, 10 years later for $850,000. So in 10 years, you've been able to double your money. So you're still paying that $400,000 mortgage at 3.5%, which it would, 4%, maybe 4.5%, depending. But the value of your property based on the market is more than doubled. So that's the growth that I'm talking about. So if you pay it, so you do the math, right? So you spend 10 years paying down your $400,000 mortgage. Maybe you still owe $350,000 on your house, but you could sell it for $850,000. Like, do the math on that. It's a $500,000 plus on your side. Now tell me if you could have gotten that in the market. Like, if you had taken $300,000, maybe, I don't know. I mean, if you took $300,000 and you stuck it in, like, things like VOO or, QQQ or SPY, in 10 years, could you make $500,000? I don't know. I mean, maybe, but the market appreciates. I think the S&P is like, what, about 7% a year, 8% a year. So I'd have to do the math on that, but it's a good rate of return if you're keeping your eye on it, and the other thing too is you got to maintain the property, make sure that it's, when you go to sell it, you can sell it for the highest value. So there's a bunch of stuff in real estate that we talk about with sellers getting their homes prepared for market, because when you live, how it is when you live in a house for 10 years with kids, things get beat up. It's like you need some paint, you need some this. So, maintaining the property, we always preach to have a company come out like biannually if you can and service the HVAC, service the plumbing, service the electrical, check on it, make sure it's all, working properly. And so that no one thing goes into disrepair for too long, so.
Yeah. You got to keep those little things in check.
Yeah. I don't know if I'm answering your question, but yeah,
no,
I
it
think
was awesome.
And that's what I've done personally. Like I'd rather speak about what I've done personally, because that nobody, everything that I can say is everything that I have, as far as an opinion, can be challenged by somebody else who has another opinion. But I can speak. I don't like to speak out of turn, and I don't like to talk about things that I'm not an expert at. But what I do know is what I've done. And back in the '90s, I bought my first property for like $89,000, sold it, made a profit, rolled that into another house that I bought for like, more than that, whatever it was. I can't remember what it was. Sold that, made a profit, rolled that into another house, and just continued to do that. So, you buy, it's just like anything. You buy it at a certain price, you sell it at another price. The profit in between is yours, or the equity, as they call it in real estate. And you just roll that into another property, and you just keep moving up. And that's how it grows,
I had a friend that in high school or college, he bought a Honda Accord, and it was pretty trash. Cleaned it up, flipped it, sold it, moved up to a nicer car, flipped up, sold it, and moved up. And we were just like, every time I saw him, he was driving a nicer car. And finally, he was driving like an Acura NSX, and it was just like, dude, where did you get the money for that? And he explained the process, and I was just like, that's rad. I didn't even know that was possible. Just trading up.
Yeah, and that's a quick way to make money in real estate too, to grow your money, is to find something that's depressed, it needs some rehab, renovate it, and then flip it. I'm sure there's tons of videos online about the thing that's called a burr.
Right?
Yeah. And that's a great, if you can get that first one, then you can get the second one, third one. So it's like a domino effect, right? So it's getting that first one that's really the obstacle. But then once you establish it, and you start rolling the profits, then it gets easier and easier as you move along, as long as you keep your eye on the ball. There are some pitfalls, and there are some things that can trip you up, but it's a calculated process. But if you do it right, you can, there's quick money to be made, Like when I say quick, relatively quick, it's not like overnight, but it'll grow fast,
What you said there was really awesome, because there was something in that I wanted to unpack. The idea, like, one of the things I was reading today is that when people, if they want to really exercise, there's one thing that you can do, and it's just start. Because you have to, like, the biggest, like, stopping point for most people with going to the gym is that they just don't want to go. It's like starting the workout is the hardest thing. And for home buying, like you said, there's some pretty big hurdles, and one of it is that it seems daunting, and there's some basic vocab that I would love to ask you about. See if you can help me explain and understand some of these.
I'll try.
Now, one of the things that they're talking about is like a down payment, like and what is a down payment, and how much should people expect to pay? Like, what is a down payment?
So the down payment is the money that you put down on the loan to qualify for the loan. So banks require certain levels of down payment. It can be as low as 3%. It can be as high as whatever you want. The more you put down, the more qualified you become for the loan, because the bank's loan to value ratio drops with the more money you put in. But with the understanding that down payment is your equity that you're already building into the property. So you're not starting. So if you buy the property at $500,000, and you put money down, any of the money that you put down comes off of the loan. So you're not borrowing $500,000. You put down $50,000, you're going to borrow $450 from the bank for the $500,000 house, which means the day you close on that loan, you've paid in $50,000 in equity in that house. And so to make it affordable for people who don't have $50,000 for a down payment, you can put as little as 3% down. And then there's also some other types of loans that are state to state. Like I know Tennessee has some special loans for people who if you can't afford the 3%, and you can apply for a certain type of loan. Obviously, you have to qualify income and that kind of thing. There's a credit score that's required in order to apply for that. But there's lots of options. So many people that I talk to, even people that I would expect would have maybe a more basic knowledge of understanding of what's required. A lot of people believe that it's 20%. You've got to put 20%
That's
down.
what I thought it was. I thought it
And
had
it's
to be
not.
20%.
No. I mean, there's lots of options. I mean, 20% designates, like with a conventional loan, if you put 20% down, typically you don't pay what is called PMI, which is a mortgage premium insurance. A bank likes to have an insurance policy on the mortgage that is tacked onto your monthly bill if you don't at least come to the table with 20%. So a lot of people don't, and then they pay that PMI, which can be, a couple $100 a month, $100 a month extra. And then once you reach the 20% threshold, you can go and refinance your loan, get that PMI off. So that's why I think a lot of people believe that 20%, I mean, that's like kind of that's where most lenders like you to be, but there's options that are below that. And when you borrow more and you put down less, then other things come into play, like your credit score becomes more important. So or your debt to income ratio becomes more important, so it's all about that monthly number. So the more you put down, the less you borrow, the less you pay each month on the amount that you're borrowing. So you can have a higher debt to income ratio because you're paying less on your mortgage each month. And because you cross that 20% threshold, there's less risk on the portion of the bank. So maybe you could have a lower credit score. Maybe you don't need a 750 or an 800. You could get by with a 700 or 710 kind of thing, So, or 650 even, whatever the cutoff is for lenders, where you start to, if you drop below a certain credit score, I think your interest rates go up, and sometimes the cost of the loan can go up because there's more risk being assumed by the bank. So it's all about managing the risk, right? So the less risk that there is for a bank, the easier it is for the bank to lend. And then, it's sometimes if your down payment crosses a certain threshold, the bank will waive the appraisal on the property because there's so much built-in equity that they're not concerned about the appraisal reaching a certain threshold against the amount of the loan. You understand? Does that make sense?
Yeah.
So it's like, it's always like a loan to value ratio. So that's what they're working on. So the more you can add in, borrow less to get a house. So if you can borrow $350 for a house that appraises at $500, the bank's going to do it all day long. Less risk.
Yeah, right. Well, that leads to my next question. Like, one of the things that when you hear about, obviously you hear about down payments, but also earlier you mentioned interest rates. Now, what exactly is an interest rate? And does the bank set those? Are they set by the government? How does that work?
Well, it's a combination of it. Like the Federal Reserve in the United States dictates what is the basis interest rate, and then the banks will add on top of that basis and calculate what their loan interest rate is. And it's different for different purchases. So like interest rates on a car loan are different than interest rates on a house. So when you're looking at a house, the number you always want to look up is the 30-year mortgage. That's going to be like your base. That's going to be where you start. And then that is the amount of money, which is a percentage, that it's going to cost you to borrow. So you borrow X plus 7% annually, and that's the cost of borrowing that money. And that's really how the banks make their money. They make their money on the interest, right? So, and that's just how it is. That's the cost of, essentially I tell people that's the cost of borrowing the money. Think of it that way.
I like that. That's really simple and easy to understand. It's just what you have to pay to get the loan. And the loan,
that's right.
And there's fun names for everything too, because like a loan and with a house is not called a loan; it's called a mortgage, right?
Right.
So
why is that? I don't know.
Right? Right?
I don't know. It's just fun terminology. The mortgage is the loan. I mean, that's essentially what it is. I'm sure there's some. Yeah, I could probably Google it and figure out why it's called a mortgage
probably
instead
some old
of
English
a loan.
thing.
Yeah, it's probably has something to do with, I don't know. I have no idea. I won't even guess. But
right.
I should probably look that. It's interesting. I'll look it up.
That's a good fact to know.
Yeah. So I'm not sure why that's called a mortgage, but that's what it is instead of a loan. It is a loan. It's a loan.
there's other costs too, though. Things like closing costs. Now, what exactly are closing costs?
Well, closing costs can be everything from, a title search, processing. There's a lot of little hidden things in closing costs. And for a seller, they're less than for a buyer because the buyer has the costs of the loan. So there's the cost of processing the loan. There's the cost of everybody doing their work on the loan. And that can be something as much, like back in the day, sometimes you would see faxing things. Like there was a cost for like just doing the paperwork, It's not a lot, it's minimal, but a lot of it is like title searches, and title insurance. So one thing when you get a mortgage, a bank requires title insurance, and what that does is in order to convey title, which is the ownership of the property from one person to the next, the title has to be free and clear of any encumbrances, or it can't be legally transferred. So you can't have a lien that's not paid off on your house.
Oh, wow.
All of your liens have to be satisfied. All of your encumbrances have to be satisfied, whether it's back taxes or a second mortgage that you took out or whatever. All of that needs to be satisfied before they can convey that. So what happens is you have a title company on both sides of the table. Though you have the seller's title and the buyer's title, and they are responsible for doing the title search. And then, from my understanding, the insurance on that costs. And what that does is it protects you, the purchaser or the seller. Well, not so much the seller, but the purchaser from anything that might get missed. So if they do a title search and they clear title, but it comes back that there's an encumbrance on there, then technically the new owner has to pay that.
Oh, wow.
So the title, so it can be a problem, right? And that can affect the loan. And that can affect what your monthly payment is, and that can affect your debt to income ratio, which affects the getting accepted for the loan. So typically the banks require title insurance, and what that is this insurance that if something comes up later, it'll be covered by the title company, and they'll have to be responsible for it. I had a friend who did that. He bought a house, and it closed, and a couple months later, it came to people's awareness that there was a lien on the house for medical expenses, unpaid medical expenses by the person who sold the house.
Wow.
And it didn't come up in the title search. And so he had title insurance, and the title company ended up having to pay off the lien because they missed it. And so, lots of things that need to be checked. I'm not a title person. I don't work for a title company. I don't know exactly what goes into the title search. I just know that they usually charge a percentage of it ends up being about a percentage of the, about 1%, 1.5% of the purchase price of the house.
It's so fascinating. It's stuff that you don't necessarily think of. I'm going to go and just buy a house. But there's all these things like, closing costs are, and I didn't know. I knew there was paperwork and there are inspections, but it's interesting. I heard that these closing costs can be 2 to 5% of the house price. So it's not a tiny amount of money, right?
Well, it depends. Yeah, it can be. Yeah, you're right. On the sales side, it's never statutory, but it has been customary that the seller, who typically is in a high equity position, not always, but in an equity position, and the seller and the buyer obviously isn't always in an equity position, they customarily have offered to pay the agency fee of the buyer. So they would pay the buyer's agency fee, and that could be 3%, right? So when the sell side, your closing costs could include, and it's not statutory, but customarily, in order to make your house more attractive to the buyer, you offer to pay for their real estate agent's fee. Which can be 3%, up to 3 or more than 3%. It depends on the market, depends on the agent. The agent dictates their commission, right? So I would say on average, historically, it's about 2.5% to 3%. Then you got to pay your agent who's selling the house, which is 2.5% to 3%. Then you have to pay your title. Then you have to pay your loan processing. So it can be upwards of 6%. On the sell side, And typically that's okay. They can absorb that because they're in an equity position and they just take it out of the proceeds of the house, the sale of the house.
So interesting.
Yeah.
Someone starts. There was one other word that was interesting that I had read that I was like, well, let's ask him about that. Escrow. What is escrow?
Escrow is a term in banking where you hold money in reserve, and typically it's held in a bank account that doesn't bear interest. It's an escrow account. In real estate, escrow is anything from earnest money to, maybe a credit that's being given to a buyer at close or a seller at close. So the most common term in real estate for escrow is what is called earnest money or escrow. And that is money that the buyer puts down or gives to the seller, to seller's title company, to hold in escrow. They just hold it.
So, okay.
During the contract period, which when you do a purchase and sale agreement, there's a series of events that need to happen to keep the contract moving forward to close. And there's obligations that the buyer has, and there's contractual obligations that the seller has. And so on the buy side, one of the first things you need to do is you need to, within 3 or 4 days of binding the contract, you give money to the seller to hold. And that money is basically insurance money. Should you default on any of the other portions of the contract, they get to keep that money. So it's like the buyer's putting skin in the game and kind of like, saying we're serious about this, and so the more money that they give, the more, technically the more money they give in earnest money, the more serious they are about purchasing that house because they have more to lose. So it kind of keeps everybody, on track. And if the buyer doesn't satisfy the different stages of the contract, then that earnest money is kept by the seller, and vice versa. So the buyer can get it back at different out points. They have different out points built into the contract. Like if the inspection doesn't go well, they can get out and then they get their earnest money back. If something else, if they have a financing contingency and the loan falls through, they can get their earnest money back. So it's just kind of like a placeholder for, I guess, kind of like a placeholder to be like, okay, we're all in this. Everybody's got skin in the game. Let's get this thing finished so that everybody can move on,
And the house has to get checked. And there's some different terminologies that people use. So they checked, like there's an appraisal, which is, I believe, where they check, they go in and look to see what is the value. But then what's the difference between an appraisal and an inspection?
So the appraisal is what the bank does. The bank does the appraisal. And they are ensuring the value of the house based on a certain criteria that they've set forth, so that they're lending on a house that has the value that they think it should be. Because again, it comes back to this loan to value ratio, right? So the house has to appraise for the amount that's being borrowed, in easy short terms. So if it's a $500,000 house, you want that appraisal to come in at $500,000 or more, but not less. That's the bank's way of valuing the house. Now, the inspection is done through the due diligence process on the buy side. And that is to inspect the property to make sure that everything, the safety and the integrity of the house is intact before moving forward to buy it. So it's like buying a used car. You look under the hood, you do a test drive, you make sure everything's working properly, before you buy it, especially if it's a used car, you're going to look under the hood. So it's like looking under the hood. You want to make sure everything's working. My buyers, when I do that, we stay away from cosmetic things, and we just really focus on the safety and integrity of the house. So the major systems, HVAC, electrical, plumbing, roof, foundation, those are really the ones that you want to focus on. Everything else can be painted, patched, or caulked, so it's like, I try not to focus on that stuff that much.
Is the foundation good? Like, yes.
Yeah.
If it's not, no.
Yeah. Don't believe me. There's a lot of them out there. You walk in and you're like, whoa. I bring a marble. So sometimes I'll bring a marble and I'll just put it on the floor and just watch where it rolls.
Wow.
And I'll be like, oh, the floors aren't level. Maybe we're definitely going to we're going to take a little bit closer look at the basement / crawl space, whatever it might be.
It's interesting.
So,
I never thought about that, but yeah, like totally.
Yeah, and sometimes it's just settling. Sometimes it's normal settling, but it can be an indicator that there's a foundation issue. So it needs to be looked at by a licensed professional, and evaluated. So
that's fascinating. Now
and
let's like
expensive.
and expensive, right? Yeah, right. I saw this photo the other day of this real estate influencer, back to our influencers, that was talking about a house that they were looking at buying until they got out to the porch and like they saw where there's this massive crack through the porch straight into the foundation, and they were like, yeah, no, no.
Yeah. Well, again, it that is an indicator, and that should be something that raises a flag that says we need to get somebody in here who's a pro that knows what they're doing to look at this, because sometimes it can just be normal settling, and a lot of times on the outside of some homes in the United States, the brick can have cracks in it, but that's just a facade on the outside of the house.
Not the
So
foundation.
the outside of the house can settle, but the house doesn't. The house doesn't necessarily mean that there's a structural issue with the house. It's like normal settling, like drywall does that in homes. Like over time, the drywall will settle and the house will settle, and there'll be like a little crack in the drywall. It doesn't necessarily mean that there's a bigger problem, but it should be checked to make sure.
What are the
Because
steps?
it could mean that.
Oh, sorry. Yeah, it could
No,
could be bad, right?
Yeah,
But,
hell yeah.
but it could be something that's fixable, I guess.
Absolutely. It could be just cosmetic,
Oh wow. What are some of the steps that you walk people through to buy a house? They come to you. Where do you start? Where do you go?
I start with the financing. That's the most important. Well, on the buy side,
On the buy side.
on the buy side, start with your financing. Get with a lender, a trusted lender. And when I say trusted, I mean somebody that when you call them, they'll pick up the phone and talk to you instead of, only emailing you or only getting back to you at certain times. It's really frustrating. So I have a couple guys that I use that are great. And I get them in touch with, obviously it's up to them to decide, but I offer the services of these people that I work with that I know and are trusted. And the idea is that you sit down and you let the person who's qualified to determine whether or not you can get the loan, look at your finances and decide how much you can borrow, how much is going to be allowed for you to be borrowed based on the parameters of your debt to income ratio, the amount of money, which your income, which is part of your debt to income ratio. It's your debt, your income, and how they affect each other. So how much debt, how much money, how much is coming in, how much is going out. So that's the first thing they look at. The second thing they look at is your credit score. And then they look at other parameters that underwriting will take into consideration as the individual, not the property. So, and then you get what is a pre-approval. So based on your credit score, your debt to income ratio, how long you've been at your job, a lot of different parameters of what you're doing, other assets that you might have that are liquidable, investments, that kind of thing. They determine a price that you can borrow, amount that you can borrow. And then that dictates, the price point that you're at for the type of house that you're going to buy.
Yeah, what type of house you're going to go for? Because if you can get, and should you borrow the maximum amount, or should you try to go for a smaller amount like that? That's something.
Well, there's a lot of philosophies with that. A lot of people believe that you should buy the smallest house on your block because all ships rise with the tide, right? So if you have the smallest, most inexpensive house on your block, then as the bigger houses grow in value, because of the location of your home, your value is going to increase, but you're not going to pay the premium for it. I'm a firm believer that you buy close to the top of your range with the idea that you're going to grow into it. Because what you don't want to do is grow out of it faster than you anticipated, because then you're going to be in a situation where you're going to move again. So if you're like, oh man, all I need is 2 bedrooms and 1 bath, and 5 years go by and you meet somebody and you have a partner or a wife or a husband, and then you start thinking about having kids or you even get a dog, that 2-1, 1,000 square feet, 2-1 is going to start to really feel small. So, I say buy at the top of your range, grow into it, let the market, increase the value. I know it seems scary, but, obviously the bank won't let you, a good bank won't let you borrow more than you can handle. They won't qualify you for it, especially post 2008. Now, prior to 2008, the reason we got ourselves into that situation is because they were doing the exact opposite. They were lending more than people could afford and giving it to them and letting them default, which was the whole Lehman Brothers thing, right? So there's a lot of laws that have been passed since then that don't allow for that anymore. A lot of restrictions have been put on the industry. So typically, if you have a good lender and you have to be responsible too about what you can afford, then, I say, go get the house that you're going to be comfortable in for 5 to 7 years.
That was my next question. How long? But can people go and do this on their own, or do they need someone to help them, like a realtor or a real estate agent?
You can do it on your own. You don't need to have, in the state of Tennessee, it's not like you don't have to have a realtor. You can buy and sell on your own. It's not recommended because there's a lot that needs to be negotiated and there's a lot of paperwork that needs to be done. So as an agent, you have access to the standard forms that are used in a real estate transaction that are dictated by the state. In Tennessee, they're called the Tennessee Association of Realtors, which is short. TAR is the short form. So they call them TAR forms. And they're kind of boilerplate contracts that have been pounded out by the powers that be and their legal team. And they put all the language in there. And then what the agent kind of does is just fill in the blanks. The price, maybe there's a couple little special stipulations that you can put in there, but they really teach us not to be lawyers. We're not there to write legal language into the contract. So we're allowed to define some of the parameters of the contract, but the legal language has already been pounded out. It's all state regulated, and there's a form that we use. I don't know the process for a person who's not an agent to get access to those forms, but those are the kinds of things that you would need. But I've done that before. Before I had my license, I've sold properties on my own. And what you can do is just hire an attorney, and they'll handle it all for you, and they'll do it for a flat fee, So, and it was great, and they handled everything. So I put my house on the market. I hired an attorney to do all the paperwork, do all the forms, do it all legally, and was able to save a lot of money selling it myself because I didn't have to pay the commission to an agent.
Well, how about this? After you check your finances, see what you're approved for, and you look at hiring a real estate or not, where should people start looking for houses? How do you even find a house,
Well, that's the thing is there's lots of things. Most people use Zillow that I deal with. They search on Zillow. So you can do that. You can just lay in bed all night long and scroll through Zillow and find a house that's in your price range. The steps of contacting the person who's selling that house would require going through an agent. So typically, so it's recommended that you use an agent because you're going to be dealing with an agent on the other end, unless you hire an attorney. I suggested that to a friend of mine who had some property he wanted to sell, and his margins on it were low. So they were really tight margins. He's a friend of mine, and he's like, man, I want to hire you as my agent, but my margins on this are really low, and I need to get a certain amount of money out of it in order for me to do what I need to do moving forward. And I was like, listen, that's fine. I get it. You're my friend. I don't care. Here's the title. Here's the real estate attorney and title company that I use. Call Ryan. He'll take care of it. He'll handle the whole transaction for you, and he'll probably charge you a flat fee. And it won't be as much as, what I'll charge you for my, for commission or the other agent, as the seller that you might end up having to pay on the buy side, So, yeah. So that's the way to do it. You'd have to get somebody involved, at some point. Yeah.
You find the house that you love, and you're just all about it, and you decide, all right, this is the house I want. How do you go about making an offer? How does that work?
Well, it's just like anything. I mean, it's not unlike, a used car. So the good thing is when you hire an agent, the agent is familiar with the market and understands the best approach of making what would be considered, a good offer or an attractive offer, or compelling is the word that they use. So that's the importance of an agent. They can do what are called comps. So you find the house that you want. Your agent does a comparable analysis of similar homes within a certain radius of that home, find out what other homes similar to that have closed for and have sold for recently. And that's all information that an agent has access to that you won't have access to. And then they can pull like 3 or 4 homes, 5 homes maybe that are in the vicinity of the house that you're trying to buy. And then you can compare what those homes look like, their configuration, the amenities, everything down to the paint color, and compare it to the house that you're trying to buy and look at the price difference. And so if the house is, so immediately I'll be like, this house is the price on it's fair. I'd say this is reasonably priced house. Sometimes you're like, wow, this house is priced low. This is a good deal. Or sometimes it's like, that's a little on the high side. I wouldn't pay that for it, And again, you have to always be balancing where the house is going to appraise. So if a seller is being obnoxious about their pricing, they're in danger of the house not appraising, which then creates a couple different scenarios that can happen. If the house doesn't appraise, a couple things can happen. The buyer can walk away. The seller can reduce the price of the house to the appraised amount so that the loan can go through, because the loan won't go through otherwise. Or the buyer can pay the difference. And when the market was really hot in Nashville, that was happening a lot. And it's called an appraisal gap. And it's something that's a very scary thing as an agent, because you're, in a competitive market where you're getting multiple offers over the ask price by people who are cash heavy. When you're working with somebody who doesn't have that much cash, you have to be you have to be a good steward of their money. And you don't want to get them in a situation where they're promising more than they can deliver. So, because you don't know what that appraisal is until you're under contract, which to me seems a little backwards. Like, you think you'd want to get you'd want to get it appraised, set the price based on the appraisal and the market, right? The market and the appraisal dictate the price. And then the buyer comes in and says, okay, it appraised at 800, I'm willing to pay X for it, Whereas the way that it was working was, as people would put the house on the market for 800, they'd get, 10 offers on it. Some of them would be as high as 950. People are willing to pay. And they would say in the contract that the house is being sold at 800. If it appraises at 800, we'll still pay 950 and we'll pay the difference in cash at close. And that's the appraisal gap. So you got to be really careful about this stuff. So, but a lot of times, that my experience is that if you put in an offer on a house that was 650 and you offered 700 for it, it ended up appraising at 700. So yeah. So that was why you always had to be really careful. Like, maybe I got lucky with my comps. I'd comp it and I'd be like, I think this house can appraise at 700, So, yeah. And that's how the market creeps up too, price-wise. It's like, people put that on the market at 650, somebody offers 700, it appraises for 700. So it closes at 700. And now everything on that block just went up 50 grand because of that one house, So then the next person that goes to sell, they're going to pull those comps and be like, they got 700 for their house. Let's put it on for 710 or 720 and see if we can get it.
And it just starts creeping up. Interesting. So you do this, and then you move to the inspection and appraisal, and then finally you move into closing. Are there any important things to remember when you're moving into closing?
Yeah, nothing should change. So from the buy side, I always tell people, like, look, I know you're excited about moving into your new house, but don't go buy a bunch of furniture on credit card between when you go under contract and when you close. Like, nothing should change. Your financial picture has to stay identical, because they're going to pre-approve you at one point, then they're going to approve you, and then right before you close, they're going to check it all again to make sure nothing's changed. And if anything changes, you're in danger of losing your loan, which means you won't get approved. And that's happened before. I know people who've done that. And it's something as simple as, even if you pay off some debt, it can be a red flag for underwriting. So just don't do anything. Just be cool for 30 days. Like, yeah, just like pay it off when you close, you can do whatever you want. As soon as you close, you can go buy a car, you can buy furniture, you can pay off debts, you can do whatever you want. But between the time you go under contract and the time you close, the best advice is just stay steady. Don't change anything.
Do you find that people get too emotional when they go into buying? How so?
It's hard not to. Well, it's hard not to get insulted by a low offer, or it's not hard not to get like annoyed by somebody who you might construe as being like, overly cautious, or maybe it's a little bit of an overreach financially, or they're being what you would consider like a greedy overreach. It's hard not to do that. So that's why another reason why you want an agent. Your agent's your buffer as well. So, you yell at your agent and be like, I can't believe that they're doing this. It's ridiculous. We're not doing that. And then your agent goes back to the other agent. It's like, my client has declined. You just keep it super chill. Yeah, like one sentence. My client's upset and doesn't feel that that's necessary. Like, is there another option? Kind of thing. So that's the good thing, is that the agents end up doing a lot of the talking and negotiating on behalf of their client without the clients being personally involved. Because, people love their homes, and they usually have an inflated worth of their home because they're personally attached to it. And when you take somebody's home of 10 years that they have all these memories and whatever, they have all these personal attachments to it, and you just boil it down to like 3 bedrooms, 2 baths, 3,200 square foot on a 1/4 acre lot, it's worth this much. They're like, whoa, but wait, like,
what about
we put these
Timmy's
cool cabinets
tooth
in.
Was knocked out there.
I know. We just put these cool cabinets in. It's like, yeah, that doesn't really translate, unless you increase your square footage, or, you do something different. It's like, the cabinets, yeah, they're nice. We appreciate that, but it's not really moving the needle, like you think it's going to move the needle, So, unless, of course, you get the right buyer who comes in and absolutely falls in love with your cabinets. And the reason they're buying the house is because of the cabinets. Then you have a leg to stand on. Otherwise, it's nice. A kitchen upgrade is worth something, but, it may not be what the person who did it thinks it's worth, And so, and on the buy side, the things that you have to temper from your buyer is when, an inspection comes in and there's problems, and then you put together your proposal for things to repair, and the buyers are like, no, we're not paying for that. We're not going to fix that. We'll give you some money at close, but we're not going to fix those series of items, take it or leave it. And then people can get upset about that. So it is easy to get emotional, So
do you find that people will get excited and overspend too?
Not often. They're not eager to overspend. Everybody's like, it's rare that people are excited about spending more money than they think that they should, So yeah. I think, I always really try to on the buy side, have them spend the money that they want to get their house, but find ways to reimburse them through different avenues of negotiating. So, when you give somebody their ask price, then you can ask for other things in return that reduce the out of pocket for your buyer. So it's like, we're going to give you want $500 for your house. Great. We'll give you $500, but we're going to ask for $7,500 toward our closing costs, or we're going to ask you to pay the full commission for my agent, plus $2,500 at close to help with closing costs, and that gives you the ability to negotiate different aspects of the contract that isn't just the price of the house, that can save your client a significant amount of money, that they would be otherwise on the hook for,
Yeah. Well, that's really interesting.
Yeah.
Are there any other things that people should consider when they're thinking about buying a house?
Yeah, I think the most important thing is your first house isn't going to be the house that you grew up in. So, don't go in thinking that you can't buy something because it's not, the Brady Bunch house.
Yeah.
Yeah. It's like, you know what I'm saying? Like, that's not going to be your first house. That's not where you're going to probably land unless, I mean, that's not everybody, but don't not buy because you think what you're trying to get is that, what you're trying to get is unobtainable at the point that you are in your life. So buy young, but understand that you're 20, so you don't need a 4-bedroom, 2.5 bath, 3,500 square foot with a big backyard for a swing set. When you're single, buy a condo. Get a condo. Get a 2-bedroom, 1-bath, 2-bedroom, 2-bath condominium, and get the ball rolling. Get it rolling. Get the equity building. Because, if you buy that condo at $300,000 in a good market, in 5 years, that thing could be $450,000, $500,000, who knows? And then you've just made a couple $100,000. And then when you sell that place, now you've got $200,000 in your pocket that you didn't have before, and you wouldn't have if you were renting. Getting us back to the beginning of this conversation. So that's the thing, is if you think you're going to rent for the next 5 years, really trying to find a way to buy.